It's June. Your accountant filed your return in April, sent you a bill, you paid it, and you haven't heard from them since. Meanwhile, your 2026 tax bill is being written right now with every check you sign, every trip you take, every piece of equipment you buy or don't buy, every payroll decision you make this summer. Most business owners think tax strategy is something you do between January and April. The smart ones know that's just when you report what already happened. And if you want to actually change what happens, you've got to move now in June, in July, in August, before the window closes and your only option is writing a bigger check in April. Today, I'm walking you through 5 specific moves that my highest earning clients are making this summer, right now, that'll directly impact their 2026 tax bill, not generic advice, actual strategies, actual math. Let's get into it. Here's what most business owners are doing with their taxes right now. Nothing. They finished filing in April, they've mentally moved on, and the next time they'll think about taxes is when their accountant sends them a questionnaire in February. That's the single most expensive habit a high-earning entrepreneur can have. Because here's the truth about how the tax code actually works. The IRS doesn't care when you think about your taxes. It cares about the decisions you made on their timeline. And most of the most powerful strategies in the tax code have deadlines, and those deadlines aren't April 15th, they're in June, July, and September. This is what separates a bookkeeper from a tax strategist. A bookkeeper records what happened. A tax strategist shapes what will happen. And if you're only talking to your CPA once a year, you're paying for a bookkeeper at a strategist's price and leaving real money on the table. So let me show you exactly what proactive tax planning looks like in the summer months with real numbers. The first move isn't glamorous, but it's the foundation of everything else. Run a mid-year tax projection for 2026 right now. Here's what I mean. By June, you've completed roughly half your tax year. You've got real revenue numbers. You've got real expense numbers. You know whether your business has grown, shrunk, or stayed flat since January. Most business owners have no idea what their tax liability looks like until their CPA tells them in March. But if you project it now at the halfway point, you've got something more valuable: time to act. I had a client last year, I'll call him David. He's a service-based consultant pulling roughly $450,000 in annual revenue as an S-Corp. In June, we ran his mid-year projection. What we found, he was on track to owe $87,000 in federal taxes by April. That number sent a clear message. He needed to accelerate 3 moves in Q3 that we'd been discussing. We did. His April bill came in at $41,000. That's a $46,000 swing from one projection meeting in June. The projection also tells you whether your estimated quarterly tax payments are right. Q2 estimated taxes are due June 15th. Q3 is due September 15th. If your business is growing and you're paying estimated taxes based on last year's income, you may already be underpaying, and the IRS charges penalties on underpayment quarter by quarter. Here's what most people don't know. You can actually adjust your Q3 estimated payment in September based on your real 2026 income. If you've had a strong Q1 and Q2, September 15th is your last chance to catch up before Q4. And knowing your actual liability now means you're not guessing. Ask your CPA for a mid-year projection. If they tell you they can't do one until December, that tells you everything you need to know about whether they're a bookkeeper or a strategist. Move number 2 is where summer actually works in your favor, and most business owners completely miss it. Summer is when most business owners have more family time. Kids are out of school, spouses are less scheduled, people are traveling, and most CPAs will tell you that's personal life. It's got nothing to do with your taxes. That's wrong, and it's costing business owners tens of thousands of dollars every year. Let me show you 2 strategies that are uniquely powerful in the summer months. The first one, hire your kids this summer. If you've got children between the ages of roughly 7 and 17, summer is the perfect time to put them on legitimate payroll. Under the tax code, you can pay your children for age-appropriate real work, things like social media, filing, cleaning your office, administrative tasks, and that payment is a deductible business expense. Here's the math. I have a client, let's call her Renee. She's a real estate investor and business owner with 2 teenagers, 14 and 16. She put both of them on payroll this past summer doing social media content, property photos, and office organization. Each earned $16,100, which is the 2026 standard deduction amount for a single filer. That's $32,200 in wages that came off her taxable income as a business deduction. Her kids pay 0 federal income tax because their earnings fall below the standard deduction. No payroll taxes either, since they're under 18 and working in a parent-owned unincorporated business. At her 37% marginal rate, that's $11,914 in tax savings. from work that was actually getting done. The key rules: the work's got to be real and documented. The pay's got to be reasonable, meaning what you'd pay anyone else for the same work, and you need a paper trail, timesheets, job descriptions, actual paychecks through payroll. Don't hand your kid cash and call it wages. The second strategy, the Augusta rule. If you own a home and an S-Corp, summer is an ideal time to schedule your board meetings, strategy sessions, or team retreats at your personal residence. Under Section 280A, the Augusta rule, your business can pay you fair market rent for up to 14 days per year. The business deducts the rent, you receive it completely tax-free. 14 days, that's 4 quarterly board meetings plus a 2-day annual retreat, or a 3-day leadership offsite in July when the weather's good and your team is already loosened up. If your home would rent for $2,500 per day as a short-term rental, that's $17,500 in tax-free income to you, and $17,500 in deductions to your company in a single summer strategy session window. The rules are strict: fair market rent, backed by comparables, documented meeting minutes, real business purpose, and you can't exceed 14 days or that income becomes taxable. But done right, this is one of the cleanest strategies in the entire code. Move number 3, plan your equipment purchases now, not in December. Every year in the last 2 weeks of December, I get a flood of calls from business owners asking, can I buy something to reduce my taxes? And my honest answer is you can, but you're doing this backwards. Here's why December equipment panic is a bad tax strategy. You're making a $50,000 or $100,000 purchasing decision in 48 hours based on your tax bill without time to evaluate whether it's actually the right asset for your business. The smart move is to plan now. Under Section 179 and bonus depreciation, currently at 100% in 2026 under the Big Beautiful Bill, you can write off qualifying business equipment, vehicles, and certain property improvements in the year you place them in service, the full deduction in year 1. But you've got to place the asset in service before December 31st. That means bought, delivered, and in operational use. Not ordered, not on a truck, in use. If you know you need a vehicle for your business, a piece of production equipment, a significant tech upgrade, or leasehold improvements on your office, summer is when you should be evaluating those purchases, getting financing approved, comparing vendors, making a business decision that also happens to be a smart tax decision, not a tax decision disguised as a business purchase. I had a client, a physician practice owner named Thomas, who every December would scramble to spend $80,000 to $100,000 on equipment he didn't really need, just to get a deduction. We shifted his planning to Q2. He started identifying actual needs in June, making purchases by August, and had time to negotiate better pricing. Same deduction, better assets, less stress. If you want the complete framework for structuring all of these strategies, my book, Your Biggest Expense, walks through the exact playbooks I use with clients, and it's linked in the description below. Move number 4 has the longest term impact, and it's the one most business owners think is a once a year conversation. It isn't. If you operate as an S-Corp, your salary is one of the most controllable tax levers you have. The IRS requires that you pay yourself reasonable compensation, but within that band, you've got flexibility. And here's what matters in June. If your business has grown significantly in Q1 and Q2, your salary structure from January may no longer be optimal. Too low a salary with a high revenue year equals audit risk. Too high a salary equals unnecessary payroll taxes. The middle of the year is when you should be reviewing that number with your CPA before you get to December and discover you've been doing payroll wrong all year. And on retirement contributions, if you've got a solo 401k or SEP IRA, June and July are the right time to review your contribution pace. For 2026, the solo 401k employee contribution limit is $24,500 plus an additional $8,000 if you're age 50 or older, or $11,250 if you're age 60 to 63. As the business owner, you can also make employer contributions, bringing your total annual contribution up to $72,000, $80,000 if you're age 50 plus, or $83,250 if you're age 60 to 63. That's up to $72,000 to $83,250 you can move out of today's taxable income and into your future, potentially creating substantial tax savings while accelerating your retirement nest egg. Here's what most business owners get wrong. They think retirement contributions are an April thing. They're not. If you wait until March to fund your solo 401k, you're managing cash flow badly. You're trying to pull a large lump sum out of your business at the same time you're paying your tax bill. The smart move is to spread contributions through Q2 and Q3. You know your income, you know your trajectory. Fund the account now, Get the compounding working earlier, and your April won't be a cash crisis. Now, here's the framework I use with every strategic client. I call it the August reset. August is the last real month before Q4 changes the pace of your business and your life. School starts, fourth quarter planning kicks in, and the holiday stretch begins. August is your final runway to make clean mid-year adjustments before the year's trajectory is set. By August 31st, your smart business owner checklist should show: 1, you've run your mid-year projection and you know your estimated 2026 tax liability within a reasonable range. 2, you've validated that your Q3 estimated tax payment due September 15th is accurate. 3, if you've got children, they're on payroll and actively working documented hours. 4, if you've got an S-Corp in a home, you've scheduled your summer board meeting or retreat and you've got documented meeting minutes. 5, you've identified any major equipment purchases you want to make by December 31st and you've got a plan to execute them, not in December. 6, your S-Corp salary has been reviewed and your retirement contributions are on a monthly schedule, not a panic schedule. Every item on that list has a dollar amount attached to it. The business owners who complete that checklist by the end of August consistently pay less in taxes than the ones who wait until Q4 to start thinking about it. This isn't complicated, it's just proactive, and proactive is what the tax code rewards. Here's the bottom line. Your tax bill for 2026 isn't going to be determined by what you do in April 2027. It's going to be determined by the decisions you make between now and December 31st, the structure you've set up, the moves you execute, and the planning you do or don't do this summer. The business owners I work with who pay the least in taxes have one thing in common. They treat tax planning as a year-round activity, not a once-a-year event. They don't stop strategizing because it's summertime. They don't hand it off entirely to a CPA they talk to once a year. They stay in the driver's seat. The tax code isn't an obstacle, it's a rule book. And if you know how to read it, you can rewrite your financial reality. So here's your action item before you close this video. Book a mid-year review with your tax advisor. Tell them you want a projection for 2026. If they say they can't do that until December, you now know what to do with that information. If you want the complete framework, the exact strategies I use with my own clients to structurally reduce what they owe, grab my book, Your Biggest Expense, at the link in the description. And if this video gave you one thing you're going to actually use this summer, hit the like button and subscribe, because I post strategies like this every week that could literally change your numbers. Remember, it's not what you make, it's what you keep, and you can still have a fun summer while doing it.